How's everyone doing? What's going on out there in the world of real estate investing? My name is Brandon Turner, and we're going to be talking about taxes and death. No, just kidding. What's the whole phrase? Life. The only thing in life that's sure is death and taxes. We're going to focus a lot more on the tax part today, but we'll cover death a little bit. I'm sure when we talk about some of the ways that you can defer taxes long term. I am going to get this thing kicked off here in the next minute or so. It looks like Amanda is connecting right now. So do me a favor, everybody, is the chat room, do you guys see a chat room? And in the chat area, can you let me know who you are and where you're from? Let me know in the little chat area. I think I have to actually turn it on. Let's see. Who can chat?
Hi, Brandon.
Hey, what's up, Amanda? Welcome. There, now the chat is turned on. So if you guys want to try the chat room, let me know who you are and where you're from. Amanda, who are you? Where are you from?
Oh, hi, my name's Amanda. I am from Orange County, California. Excited to be here.
Awesome. All right. Well, we'll give people another minute or so to get in. Let me do a couple of quick shout outs. We got Josh from PA. You were the first one. Let's see. We got Derek Clark. What's up, man? Let's see. We got Brian from Grand Rapids, Michigan. We got Trent from Phoenix. Hello. Kate from New York. Jenny from Southern California. Mandy from Nashville. And a whole lot more.
I'm dizzy just looking at all these pop up.
I know. There's so many. All right. Fred and Ashley from South Carolina. SC, that's South Carolina, right? It could be Southern California, but I'm going to go with South Carolina. Christina in Honolulu. I'm actually headed to Honolulu tomorrow.
Where are you? Where are you right now, Brandon? You don't look like you're in
Idaho.
Oh, you're in Idaho.
Yeah, I'm in Idaho right now. I've been here for a little while, for about a month, and headed back to Hawaii tomorrow to spend the rest of the fall there. So
awesome.
Yeah.
I see you on Instagram with all the fun stuff, with all the fun jet skiing or water skiing you guys are doing.
Yeah, we did the what's it called, wakeboarding. It was a good time. All right. Well, everybody, hello. So a couple of quick housekeeping things and we'll jump into this. So what is this? Today, we're going to be doing kind of a discussion about taxes. Why? Because it's important. If you are going to be in real estate, it's important to understand taxes. I don't have a course. I'm not trying to upsell a course or anything like that today. There is no that. I'll tell you about my bio here in a minute, but just know that we just want to deliver value to you guys. I just found a tremendous amount of my success has come from providing value to people and just giving and doing things like this. We do webinars from time to time. In fact, Amanda, you and I have done one of these before where we answered a bunch of questions for limited partners when having to do with taxes. So yeah, I'm excited about that today. So yeah,
it's funny how this all came about in the last couple of days. Just to share with everybody here, I was actually on vacation last week with my family on the beach, and I get a text message from Brandon. So we're just talking back and forth about taxes and real estate, and of course, Brandon said, "Hey, let's do a webinar next week." So here we are.
Let's do it. I'm such a big believer in like not putting things out into the future really far. Like I like short deadlines because they make a bias for action. It's like, hey, we got to do it right now. And yeah, and this is proof of it, right? I told my team, they got everything running, and things sometimes break and we figure it out. But so far everything's working good. So we'll just keep this thing going.
Yeah, and I like how you turned our text message and you said, let's just share it with the world, and we'll take this conversation to the webinar.
There we go. Well, I started this conversation too. I'm going to show everybody something. I don't know if I can actually share it in here. I'll try to find a way to get a link. But let me see, I'll share the screen. I wrote up a guide. Let me see if I can open it. Here it is. I wrote up a guide called How the Rich Pay No Income Tax. This is where this whole thing started, is because I messaged Amanda and I'm like, hey, can you look this over? So the purpose of this, we are in the middle of a big raise for a couple different deals that we're buying, huge apartment complexes. So we're in the middle of this. And so I wanted something to give to potential investors to say, here, read this. Here's why taxes are important. And so I sent it to my team and everyone's like, Brandon, this is really good, but we should probably have Amanda review it because she's a CPA. And so Amanda goes through and fixes a bunch of stuff and makes it actually work a lot better. And this is what I wrote. So I'm going to try to find this for you guys here in a little bit. I try to get a copy if you guys want to look at it. But I basically go through the strategy. How does Donald Trump, and now I don't know Donald Trump, I don't know exactly his tax strategies, but if I was a betting man, I would bet he's using exactly what some of the stuff we're going to be talking about today to pay almost nothing in taxes. The New York Times said he paid $750 in federal income taxes the year he won the presidency. which is, I was kind of surprised he paid that much actually when I heard that. I was, I was like, he needs to work with Amanda. He'd probably pay even less. But anyway, so that's what this is about. So that's what started about how real estate works, how depreciation works, how bonus depreciation works, what a cost segregation is. And that's what we're going to cover today, that and some other stuff. So yes, I will share that white paper. I just don't exactly know where to give it to you now because I don't know how to share it on Zoom. Do you know how to
put it
share
on the
things on
chat
Zoom?
box, I think, if you have the link to
Yeah,
it.
I don't have a link. I don't know a link though. Let me see if I can find it. Hold
Okay.
on. Hang tight, everyone. Amanda, talk
Yes.
for a minute.
All right. all
Maybe
right,
introduce
yes.
yourself. Who are you? What do you do?
Yeah, so well, my name's Amanda, for those of you who don't know me, and I'm a CPA, tax strategist, and real estate investor too. So our passion is in helping real estate investors to use taxes or to use real estate to save on taxes. And I'm really excited to be here. Like Brandon said, just really here to try to spread the message, teach people on how they can use their real estate to really reduce taxes. And what's really interesting is, I think a lot of you guys on here, or people who might not know, but Brandon is not just a friend, but a client as well. And I often have investors who come to me and say, hey, I love to work with you, but I'm not Brandon Turner, so I'm probably too small. And what's really funny is that, Brandon Turner wasn't even Brandon Turner when I first met him. And so
I feel an embarrassing story coming along.
yeah, no,
Okay.
not at all. But I was looking back because it's been several years since we started working together back in like 2014. And like I said, back then Brandon was very different than where he is now. So just looking back at some stats back in 2014, when we first started working together with you, Brandon, you had 8 rentals, some of them with partners. But guess what else you had? You had 10 legal entities. How crazy is that? A lot of legal entities. And one of the first things we did, we said, can we get rid of some of this legal entities? It's costing you so much money. But what was really interesting, I don't even know if you remember this. Again, I looked it up today before I got on the webinar. You paid more taxes in 2014 than you did in 2020, and you will in 2021 and 2022. So you actually owed taxes in 2014 when we did the tax return. I didn't write down the number, but you owed like a couple of $1,000s in taxes. And back then your income, your income was like, funny. I don't know, 2% of what you're making now.
That's hilarious. I got to use that line. That's funny. I paid more taxes with 8 rentals than I do with 7,000 or whatever. I don't know, whatever we're at now.
Yeah. Yeah. So I mean, that's just to show people like anybody can do it. You don't, we all start somewhere, right? Like, Brandon wasn't who he is today. And when we started working together, it was a very different profile, different story, but now he is where he is. And of course, we're also going to talk about how, like, because I always get this question a lot too. It's like, well, I want to be, own a ton of real estate, but maybe it's not for me. Maybe I don't want to build a team, and I don't, maybe that I don't want that to be like my job. And I think today, Brandon, hopefully you're going to talk about how people can do that, right? We can have some of the tax benefits and grow wealth and hedge against inflation without, becoming Brandon Turner and doing all of these things every day, right?
Yeah, exactly. So yeah, my hope is that like a lot of people that are watching this, I mean, in fact, many of you, in fact, in the chat area, by the way, you can choose. Let me just give a little housekeeping. You can choose to send a chat to all panelists and attendees, or just hosts and panelists. So make sure you change the icon to go to all panelists and attendees so you guys can see each other's comments. That way we can have like a conversation. But go ahead and do that and let me know, who is anybody here currently investing with Open Door Capital, or is anybody here like possibly going to invest with us in the future? Like you're maybe going to do that at some point. Okay, so a bunch of you are. I can see them coming in. Not all of you don't have to, but some of you either are or probably will. So many of you, one of the reasons I want to do this webinar is because you guys are going to take advantage of a lot of this stuff automatically just for being a part of it. Some of you will never invest in a syndication like mine. Maybe you're not legally able to. Maybe you just don't want to. You like getting your hands dirty and doing real estate. That's great for you as well. You guys will be able to take advantage of this stuff as well. So either way, you win. That's the hope, right? So you like, if this helps you, if it helps my clients and it helps Amanda's clients and it helps people that don't work with either of us, it feels like a good win-win. So with that said, and thank you, by the way, to everybody who's in one of these deals. You guys are awesome. For those who don't know, my name is Brandon Turner. for maybe you came from Amanda's list, you never heard about me. I've been investing in real estate now for 15, 16 years, got very slow start, bought a property, bought another. Then over time, really ramped that up over the last like 4 years. And I started a company called Open Door Capital. So we are a private equity, basically real estate company. People, retail investors. We don't work with the big hedge funds or Wall Street. We raise all the money from my own world, like people who listen to me on the Bigger Pockets podcast, which is the largest podcast in the world. I did that for 9 years. Or people who have read my books. I've written a bunch of books, published through Bigger Pockets, sold, I think, 2 million copies at this point of my books. One of them is the best-selling real estate book on Amazon, which is just crazy. It shows how big Bigger Pockets is. And yeah, now I buy real estate using people like you. I do the majority of the work, me and my team, and then you guys get the majority of the profits and a lot of the tax benefits. So that's kind of what I do. And then that's what Amanda does. And with that said, Amanda, anything else we should introduction here, or should we just jump into some topics?
No, I think we should jump in. I think, like I mentioned a little bit earlier, inflation is on people's minds, right? We kind of feel that every day when we go to the grocery store, we go fill up our gas. If you're not driving an electric vehicle, we kind of feel that pain every day. So I'm getting a lot of questions from me, at least from my clients. They're like, hey, should I invest in real estate? Is this a good time to invest in real estate? And, I just kind of want to start off by saying that inflation and taxes are actually two of the biggest wealth killers. Wealth killer meaning, what is preventing us from reaching financial freedom or, keeping more of the money we make. And these are two of the biggest killers of wealth. And so, kind of getting understanding, if you can touch on why, is real estate good for inflation? And of course, I'll talk about is real estate good for tax savings, right? So giving away the answer to that question, obviously. But I think obviously most people here today right now are already interested in real estate, right? So hopefully we're not having to convince them to do real estate, but kind of talking about the importance of real estate investing as it exists in today's climate. Like, are you buying right now, Brandon? If so, are you scared? Why are you buying?
Yeah, that's a good question. Am I buying? Am I scared? And today's obviously a big day. Fed raised rates again on the bank. So we're gonna talk about that maybe a little bit as well. Short answer is yes, I am buying. Am I scared? No, I'm cautious. There's a difference there, right? By the way, in the chat area, I just put the deck there. It's not really a deck, and we're not really going to go through it. I just wanted to give you that. Please don't let it distract you. I'm giving it to you now. It's in the chat area. It's just a Google Drive link. I just threw it up there just now. But anyway, that's the how to rich pay income taxes. We'll go through a lot of the stuff here throughout this. So, all right. Am I buying? Yes. In fact, right now at this moment, I've got a 369 unit under contract in Austin. I've got a 128 unit in Daytona Beach, Florida. I've got a 182 unit right outside of Atlanta, 198 unit, another one in Austin. Plus a couple more that are coming down the pipeline. So I am still buying right now, but I'm cautious in that I'm only buying in areas that people are moving to at rapid pace. In other words, in fact, let me tell you guys a quick story. So Amanda, you have not done this with me yet, but I want you to someday. It's called whale hunting. In Maui, we do whale hunting. We get paddle boards, we paddle out into the middle of the ocean, and we try to get as close as we can to whales. Now, you're not supposed to get within 100 yards, but they can get in front of you. They can get close to you. So we will paddle to where the whale, not where the whale is, but we'll paddle to where the whale is going. And then we'll just sit there. And a lot of times the whales will come right under us or right around us. It is the scariest yet most exhilarating moment of my entire life. I love whale hunting. And then we take the paddle that we have and we jump on the whale and we shove it in the blowhole and we ride. I'm just kidding. No, but Amanda, your face was like, no, but we just let the whale go by us. Now, why do I bring that up? Because the truth is, if we want to see a whale up close, you don't paddle to where the whale is, you paddle to where the whale is going. This is exactly what I do in real estate. I'm not paddling, I'm not investing for what things are today necessarily. I'm investing for the future. Where do I think things are headed? Where are the big whales moving toward? So when I see the amount of money the government is printing, the level of inflation we've got, the rents, not just where they've been growing from, but where the supply and demand is pushing them still every month higher and higher and higher. I say, where do I want to be? Where do I want to stop my paddleboard and sit there and wait for the whales to hit me? And that is areas like Austin and Atlanta and Daytona Beach. And so that's what I focus on. And that's why I don't just buy anywhere. I buy in areas that people are moving to and areas that I have strong teams that can handle. If a recession comes, we can handle it. In fact, like this is going to be a weird recession, right? Because jobs are so strong during this recession. So that's the answer to that question, Amanda. Yes, I am buying. We're just being very careful about where we buy and how we manage them.
Yeah. And so do you feel like real estate is a good hedge against inflation in general? And if so, or if you don't, then why?
Yeah, no, I think it's one of the best, simply because one of the biggest pieces of inflation, like by far, I mean, way bigger than gas, right? Everyone talks about gas prices, but it's rent. Like rent is the biggest thing that people are talking about when it comes to inflation. It's a big piece of that 9.1 number is that rents are going higher and higher. And so I want to buy an asset that is going to go up with inflation. I don't expect inflation to go down. Like, I don't think all of a sudden the cost of rent is going to drop from 1,000 to 500 when so many more people are moving to these areas. There are areas where that could happen, but I don't see rent dropping when supply and demand is pushing, and they didn't build enough housing for 10 years. So when you combine all these things together, they didn't build enough for 10 years. We've got a really strong job market right now. We've got not enough housing. We've got a housing crisis. That's a whale that I want to be in front of again. And that's why I'm so bullish on this. And then if inflation does go crazy, what's it going to go crazy with? Rent, primarily. So yeah, I think it's a huge hedge. And if rent doesn't go up by 10%, 20% per year, like it's been going up in areas like Austin and Daytona, that's okay. We're underwriting 3%. Like we're assuming like all of our projections for all our incredible returns and all that we put out there to investors, we're looking at a 3 or 3.5% per year inflation for rent in Austin, in Atlanta, in this, because I want to always try to under promise or underestimate. And then I hope I just get blown out of the water with actual projections. So that's what we do.
Yeah. And I think also too, like debt, right? Debt during inflation is good as well. Good debt, right? Not credit card debt, but good debt in terms of investment debt, because if you have the fixed note, then the payments stay the same, but it's cheaper, right? It's cheaper in terms of real dollars due to inflation. I think I can't remember who said it, but there's a famous quote that says inflation punishes the savers and rewards the borrowers of good debt. So people sitting on cash, right? That's not good from an inflation perspective, but putting into hard assets is a good hedge. One of the things that I hear people talk about is like, hey, as inflation occurs, maybe it's a good thing because my income is also going up, right? Because we know it's a tight job market. Anyone who has a business or even in the real estate business, it's difficult to find people. You're paying them a lot more than what you used to. And as someone earning income, it's like, hey, great, costs of things are going up, but my income is going up as well. But I think a lot of times what people aren't factoring in is that your taxes are going up too, as your income goes up, right? So if I used to make $150,000, I was at a 24% tax bracket. Now I make $200,000 a year because of inflation. I'm super happy, but my tax rate also increased from 24% to 32%. So I have a lot less money now to pay for all those, inflated prices. And I think that's also why it's really important to look at tax planning too, not just, in the general sense, but, outside of inflation, we already know that research shows taxes is the number one expense for Americans, right? And in fact, we spend more money on taxes than we do on food, clothing, and housing combined. And by we, I mean regular people, not you, Brandon. But for a lot of people, right? For Americans, right? The research is from taxfoundation.org, and the research was Americans as a whole is how much we're losing to taxes every single year. And as our wages go up, we can expect a bigger percentage of that to be lost as well. And I think that's where, real estate it comes in handy as far as one of the favorite vehicles when it comes to investments that produce tax savings. Yeah,
good stuff. Well, why don't we get into the Donald Trump tax method, which again, I have no idea if Donald actually uses the strategy. Maybe they got more fancy things than that, but I would almost I would be shocked if he's not using this. So,
Yeah.
do you know Amanda? Like, is there
Yeah.
like, I'm sure he doesn't talk about it.
Yeah, no, I agree. It's I mean, yes, so some of that stuff is public information. So you can,
Yep.
for the tax geeks, we can see into it. But yes, I mean, a big part of that, right, undoubtedly is real estate, which is what we're here to talk
Yep.
about. But yes, there's other strategies in terms of charitable planning and gifting, and that's used by a lot of high income, high net worth individuals. But I think for today's discussion, a lot of what you wrote about in your white paper on the tax strategies, how wealthy people pay little to no taxes, I think are some of the same ones used, by Donald Trump, and the ones that are used by you, right? So yes, we can talk about somebody else who's kind of out there, in the White House, but also we can talk about someone sitting right in front of us today, like you, Brandon, right? So I think just experiencing how when you were making W-2, that was the majority of your income, and how little we had to play with, to now when it's almost like unlimited possibilities in terms of what can be done every year, but doing that in conjunction with the goal of buying real estate and having income and cash flow, to kind of get the best of all worlds, right?
Well, I remember you used to always tell me, and you used to always say, just buy more real estate, Brandon, just buy more real estate. And I never really understood what you meant by that for years. I'm like, I am buying real estate. You guys just buy more real estate. If you want to save money in taxes, just buy more real estate. And finally, now I feel like I kind of get a good idea. So what I'm actually going to do is bring up a gigantic whiteboard. I'm going to write down some terms, and we're going to talk about each one to kind of set a foundation for how you can use real estate to save money on taxes. I need to find my pen here. Hold on.
You are so funny.
Here we go. I like giant whiteboards. All right. So we're going to explain a few terms for y'all. Hope you can all hear me here. And I don't think this is backwards, but let me know if this is backwards. All right. The first one I want to cover is this term depreciation. That look good?
Yep.
All right. So depreciation, you've heard the term before. It looks good. It's not backwards.
Good.
Okay. We're good. All right. Yeah. Somebody know they didn't know they make Post-it notes that big. They do. And it is an actual Post-it. It sticks on the wall. All right. So let's just say, and I'm going to explain it in Brandon language, and then Amanda's going to tell me all the ways that I screwed this up. But imagine you buy yourself a copy machine for your business. This is a copy machine. It's a 3D copy machine because I'm an artist. And that copy machine costs you, let's call it $1,000. So the government does not let you write off that, even though you spent the $1,000, they're not going to let you necessarily write off the whole $1,000 in the first year. They say, wait, you're going to have that copy machine for the next 5 years. So we're only going to let you take $200 per year. So they take the 1,000 and they divide it into, let's call it 5 years. Again, I don't know if copy machines are 5 years, but everything's got a life. And they're going to basically let you deduct, right? As I'm using the right word, $200 per year. Is that good?
Depreciate. Yeah. Depreciate. $200.
Okay. Depreciate $200 per year on this copy machine here. That's making copies for you. All right. So then at the end of it, they assume that this copy machine is going to be dead after 5 years. And that's why you deduct it over 5 years. They also make you, this is not optional. The government makes you also depreciate your real estate. That is a required thing from the government. Now, not the land, but the value of the property. And I don't want to go into detail on that, but the value of the property is deducted over a certain number of years as well. So now we have our house, 3D house, because I'm also an artist. It's got a chimney. All right. So our house here gets divided over, the value of the house gets divided over 27 and a half years. Amanda, do you have any idea why it's 27 and a half?
I don't.
Where that number came from? Yeah, like somebody just made that up at some point and said, well, that's about how long a house lasts for.
Yeah.
Is 27 and a half years.
Don't forget the half. Very important.
Here, hold on. I'm going to move this over here. And that way.
So Roger asked the question, commercial is different. So yes, Roger, commercial depreciation is 39 years.
There you go. Why is it not 39 and a half? Who knows? But
not half. No, just regular 39.
Just so. Okay. So we got a 27 and a half for the house. Now let's say the property is worth 275,000, or so the house is worth 275,000. Even if you didn't pay cash for it, even if you got 100% loan, let's just say for simplicity, you didn't even put a dime out of your pocket to buy this $275,000 house. They're going to make you divide that over 27 and a half years, which gives us, what's that? $10,000 a year. Am I doing that math right?
Yep.
I think so.
Let me get my calculator.
Yeah, we're going to go $10,000. So every single year you get to depreciate $10,000 on your taxes. So if you made $10,000 in if you made $10,000 in cash flow in passive income, let's just say, and you have a $10,000, basically a loss. So you're plus 10,000 and minus 10,000. The government says basically it looks like you made no money. Is that a decent way of explaining that, Amanda? Any
Yep.
corrections?
Yep. So
Okay.
basically that just means you're not paying taxes currently on that $10,000 of income compared to if you made $10,000 working at your job, you're likely just going to pay taxes on that income, right? So that's the difference. And what I love about this is, I like the pictures first and foremost. You are an artist, so it's a really good way that you've simplified it. And what's really important is that what you kind of briefly touched on is that has nothing to do with the down payment, right? It's strictly based on the purchase price of the building. And so if you're buying something with no money down, or you've only put $5,000 down, the numbers that you're seeing on this posted is going to be exactly the same. And that's why from a tax perspective, we love leverage, right? Because if you can take $10,000 and buy a $50,000 property or $100,000 or $200,000 property, that's a lot higher depreciation than $10,000 on a $10,000 property. Right?
There you go. All right. So this is the concept of depreciation. You take your property, not the land, divide it over a certain number of years. The house is, again, a residential is 27.5, commercial would be 39. Amanda, where's multifamily? That's still residential, right? That's
Yes.
still
Yep.
27?
Exactly.
Okay.
Yep.
But like a shopping center would be 30,
shopping
or 20,
center, medical
39.
office, those are our commercial buildings. Yep.
All right. Now, let's just say should we cover recapture right now or cover it later?
We can cover it later when we talk about,
Okay.
exiting real estate. But I think since you're talking about depreciation, something really important to be looking at this year is bonus depreciation, right? So what you've put on there, Brandon, is just the regular depreciation. It's just normal depreciation, what we consider slow and steady, what the IRS allows you to do. But there's also what's considered accelerated depreciation or cost segregation. And what that is when you have a cost segregation firm look at the property and they're saying, hey, instead of $275,000 worth of building, let me take a look at what are all the components that make up this building. So what makes up the 275? Well, maybe there's 10,000 in flooring, maybe there's 20,000 in specialty plumbing and appliances. And by breaking out those different components, you can write them off over shorter lives, meaning instead of waiting 27.5 years, maybe we can write them off over 5 years, 7 years, or 15 years. And so the lower the life value, the larger the depreciation up front, right? And what we love about this current year is that for a lot of those items that you break out through cost segregation, you can take bonus depreciation, right? Bonus depreciation just means that you're taking a lot of that upfront immediately rather than having to wait even the 5, 7, or 15 years. And so right now in 2022, bonus depreciation is 100%. And so what we're seeing a lot is that in the first year with bonus depreciation cost segregation, sometimes the first year write-off could be as high as 30% of a building. So if we use, 20% down payment on $100,000 property, right? Well, let's assume like 80,000, that is the building. First year depreciation could be as high as 24,000. So pretty amazing, right? $20,000 down payment gets you a $24,000 tax deduction in the first year.
Yeah, that's awesome. So the idea of bonus depreciation is normally what you have to spread out over 27.5 years. You can condense a lot of it, not all of it, but a lot of it down to 1 year. And so let's just say, again, to go to this example, right, the $275,000 building that we were taking $10,000 a year, let's say now we're 30% of that.
Mm-hmm.
So I don't know, whatever, let's call it 100 grand for easy math, right? It'd be rounding up a little bit.
300.
So now instead of a $10,000 loss, you've got a $100,000 loss.
Yeah, exactly.
So now let's say your income over here, not income, again, we'll talk about real estate professional in just a minute, but let's say you made $100,000 in cash flow this year, right? And again, this is really simplistic. It gets a little more than this, but this is a good idea. You mean $100,000 in cash flow, or what are some other types of passive income that it can offset? Is there another
Well,
example you can
all
give?
types. If we're talking specifically about syndication, right? Or syndication, or if you're just investing passively in like a single family home where you're not a
Yeah.
real estate professional, but you have high income, those are considered passive losses in the tax world. And passive losses can offset all types of passive income. So your question, what's an example?
Yeah.
So we had a doctor client that we're working on just a couple months ago. Okay, so this physician, he works a W-2 job, right? He gets about $400,000, I think, of W-2 income. He also invests in a surgery center. As a passive investor, right? Because he's a physician, he's like, I got my
Yeah.
money, I'm going to invest in these various things. So it's a surgery center and the building behind it. So he makes about 150,000 of passive income from the surgery center. So for this particular person, he had 550 of total income. And what he did was he put, I think it was about $200,000 in a syndication. And in that first year, he got about 150 or 160,000 of a loss on his K1. So again, because passive losses can offset income, taxable income from passive income, he was able to use all of that to offset all the tax he was previously paying on the surgery center that he invested in. So for that particular person, he saved like $53,000, $54,000 in taxes just with that one passive syndication investment. I think it's so important to bring that up because oftentimes I'll hear people say, hey, this all sounds great, but I've been told, or my CPA says, there's no benefit. There's no benefit for me to invest in real estate because I'm passive or I'm not a real estate professional. And that's not really taking a look holistically, right? They're just saying, well, you can't use it to offset W-2 income, but what about other passive income that you might have or future passive income, right? Because again, our goal, I think for most people, we're not planning on working forever and ever, right? We want to move towards that passive income side of the equation. And so having these losses will help you to reduce taxable income. It just, the question is only a matter of timing. Am I using it today? Am I using it a year from today? Am I using it 3 years from today? Right? So there is always benefit to investing in real estate. It just differs for each taxpayer when.
And you're saying you can carry it forward. Let's say you can't take this $100,000 depreciation, like, loss or whatever right now, but maybe next year or 5 years from now, you can. So you can carry that loss forward to future years, correct?
Of course. Yeah. You never lose out on those deductions and benefits. It's just a matter of when you can utilize it. And that's why I always tell people, I almost feel like it's inaccurate when CPAs tell their clients, like, there's no benefit. You shouldn't do it. It doesn't make sense. Because I think they're correct, but only in a very tunnel vision where we're looking at this year, this W-2, it doesn't help. But why don't we then create more passive income, right? Why don't we invest in more deals, more single families, more syndications to create that passive income so we can have that be tax-free money to us, right?
Yeah, that's awesome. So anyway, so the depreciation, obviously it can offset the passive gains, right? I mean, if you have, again, passive income from a business you invested in, now that does not include stocks, correct? That's one thing I used to think that it offset stocks, but because stocks feel passive to me, right?
Yeah.
But they're not.
Exactly. Yeah. That's one of the things I corrected on your white paper.
Yep. I know you did. I know you did. Not stocks, but is there any form of that, like not mutual funds, not stocks, anything like that, but it's just like you're a passive investor in somebody's business or in some other form like that?
Exactly. Like in the example I just used, right? They invested in a passive business, which was a surgery center. We have clients who are physicians that they invest passively in like a dialysis center, an eye care center, that's a business, right? Not necessarily real estate.
Yep.
And of course, most real estate is, falls under the definition of passive. And I think the stock part where people are often confused on is the whole term of capital gains. So for example, if you own a single family home, you sell it, you're going to pay capital gains taxes, right? But if you have passive losses from a syndication, let's say, you can use that loss to offset capital gains on the sale of the rental. So they do offset each other because they're both in the same bucket. But because we call it capital gains, I think a lot of times people think, oh, okay, capital gains when I sell stock, I can also offset, but it's different. Although they're both called capital gains from stocks is different than capital gains from rental real estate. Does that kind of make sense?
That's good to know. Yeah, that makes a lot of sense. So that's why a lot of our investors, like, they will a lot of our investors invest in a lot of different people's syndications, or they invest in a lot of my syndications. And as they come, we eventually sell the property, they get this big chunk of money. They're getting their investment back, and they're getting much more than that because their money grew. So then that's why they want to then invest in more real estate, because then they can offset the taxes that they owed from their passive investment before into new real estate. So they just keep rolling it. And that way they just kind of avoid taxes over and over and over. Is that a good way of defining that?
Yep, exactly. And I think, yeah, for like your syndications, for example, or even just a lot of syndications or real estate in general, right? I mean, we're very high in the market right now. So a lot of people are exiting. And another example of how a purely passive investor can benefit. So we have a client who has owned, a portfolio of single family homes for a long time. He's actually a retired firefighter chief. And so he retired. He's been investing in syndications. Why? Because he's retired. He wants to like travel the world. He doesn't want to do too much in real estate. And he's told me time and time again, Amanda, I'm not going to be a real estate professional. My wife is not going to be a real estate professional. But passive investments help him. Why? Because they do help offset all of the taxable rental income from his single family portfolio. Right. So it's very, very helpful for him. And now he's at a stage where he's like, hey, I don't even want to deal with these single family homes anymore. I want to be even more retired. I'm going to sell, right? This is the top of the market. I'm selling my properties. So huge capital gains. And for that particular taxpayer clients, like, hey, I'm not going to do 1031 exchange because I don't want to be involved in the day-to-day operations of owning my own multifamily. And so a great way for him to utilize the benefit of passive investing is now he can just invest in syndications that will have losses that can help him offset all the capital gains on the properties that he's selling, right? So he's held these properties for decades and there's no more depreciation. So he's looking at a huge gain, but most of that will be wiped out simply by redeploying that money into other passive investments that he gets. So again, another example of how, real estate investments benefit all types of people, regardless of the fact that you're passive and you're not a real estate professional, right?
Well, so let's shift gears and talk about the real estate professional, right? So
you're waiting on that, huh? You're waiting to share that with us.
I was very excited about this one. All right. So we've got real estate professional here. What does that mean? Does that mean they're a real estate agent? Does that mean what is a real estate professional?
Yeah. Well, so let's talk about first the benefit of real estate professional. Okay. So if you're a higher income earner, typically, 150,000 of income or more, then your rental losses only offset other passive income. Okay, so like we talked about earlier, someone making 400,000 a year, your rental losses aren't going to wipe out taxes from your W-2. It's going to be considered passive. So you don't get to benefit from it today. You do get to carry it forward. You can use that at some point in the future, right? Now, there is a loophole or workaround for this, whereby you can use rental losses to offset your other income, like W-2 or retirement income or stock gains, crypto gains. And that is if you or a spouse qualify as a real estate professional. Okay, so in other words, if you or a spouse, if one of you qualifies as real estate professional, you can then use rental losses to offset all types of income. It's no longer limited to offsetting passive types of income. So to be a real estate professional, it doesn't mean you have to be a licensed realtor or anything like that. When it comes to the tax code, they look at the number of hours that you're spending. Okay, so at a minimum, you have to spend 750 hours in real estate. And then you have to also spend more time in real estate than your job. Okay, those are the two keys. And then you also have to meet what we consider material participation rules, which just means you're actively involved in the hours you're spending in your real estate. Now, for I think a lot of people, the hurdle is not the 750 hours. The hurdle is more time in real estate than your job. So for someone who's working full-time as an attorney at a law firm, for example, if you're working 2,000 hours a year, to be a real estate professional, you have to spend more than 2,000 hours, right, to meet that qualification. So sometimes difficult to meet. But if you're someone who has a stay-at-home spouse or a retired spouse, then that could be an opportunity, right? Because only one of you has to meet the rules, and then both of you will get the benefit. So you think a full-time attorney and a spouse. Oh, is that Heather right there?
That's a little spouse. Yeah, a little spouse. So that's actually what a lot of people will do is their spouse will qualify as a real estate professional, even if they aren't.
Yes.
So let's talk about how to maybe make that happen for a second. If somebody becomes a real estate agent, does that, and they work 750 hours, does that make them one, or does that have to be a rental, like a land? They don't have to be a landlord, right? They can be an agent or no agent. How does that
So
work?
if someone is a real estate agent, those are considered real estate professional hours. So it is helpful, okay, in the whole scheme of things. But you also, one of the things I mentioned, the other requirement is you have to have material participation, right? Several different ways to qualify. We'll kind of use one of the most common ones, which is you spending at least 500 hours in real estate. And that is the rental real estate we're talking about. So if someone's purely, a real estate agent or a broker, they're not going to be able to meet that. They have to own rental properties in order to have those rental hours, right? And material participation. But also too, right? If you're just a realtor or broker and you don't own rental real estate, then there's no large depreciation, right? Because the depreciation is from the building. So you have to own real estate to begin with, right?
So let's say you're a real estate agent working 750 hours. Your spouse is a real estate agent. They're working 750 hours or more. And then you are a participant in like a passive investor in my fund. You invest with Open Door Capital. Is that going to allow it, or do you have to have your own rental property to count?
So who's in your scenario, whose rental property is it? Just your
Let's say
spouse's?
no, like nobody, like they don't own any rentals themselves, but they only invest passively in Open Door Capital. They don't even own their own house. They own nothing real estate, but they're an agent and they invest with Brandon. Can that count towards
It's
their
going to be
professional?
difficult, if not impossible, to do it. And the reason is because you have that material participation, right? 500 hours on the rentals you own. And I'm sure you'll talk about this when we talk about syndications, is when you're a passive investor, by definition, you can't materially participate. Right. And that's the benefit of, from a transactional perspective, you're not doing much, right? Brandon's team or whatever syndication you're investing in, that team is doing all of the work. So you don't have to worry about doing that. And so that's why from a tax planning perspective, it is difficult because it's going to be difficult to rack up 500 hours. And odds are, unless you're one of the GPs, you're limited in what you can do. But here's the good thing, though. I'll give you another example. Okay, let's say that you're someone who is a real estate professional with respect to your own rental properties, right? And I have a lot of clients in this scenario who, let's say it's a working spouse, and then another spouse is claiming real estate professional. They are spending a lot of time on their small portfolio of rentals, maybe locally. And what happens is, if they are a real estate professional with respect to their own rentals, then oftentimes they can use losses from syndications like Open Door Capital or just any syndication. They can use those losses to offset W-2 and other income just the same as their own single family homes. So this works really well for a lot of our clients who they love real estate, they've grown a portfolio, they want to scale and take to the next level. But again, they don't want to become like a Brandon Turner, right? They don't want to go out and buy large apartments or mobile home parks on their own, but they like the tax benefits of it. So it's a good way to kind of have a little bit of both, where you still have your portfolio that you're somewhat active in, get those hours, meet those requirements. And then for the rest, when it's more scalable, you invest in different syndications to generate more losses to offset the earned income. Right?
Okay. And how does the IRS track your hour? I mean, do they want you to check your hours? Who's checking hours to see if you're actually getting the right hours in?
Yeah, I wish the IRS would track hours. That would be good. But no, it's the investor. Everything in the tax world. Well, so in our legal system, right, you're innocent until proven guilty, right? That's the U.S. legal system. But for taxes, it's kind of the opposite. Okay, you're sort of guilty until proven innocent, and by that I just mean the burden on proof is always on us as a taxpayers. And so from a planning perspective, right, when it comes to tax planning, it's not enough just to say, I am a real estate investor, or I came to this webinar and I think I'm a real estate investor. You really want to be able to prove it, right? Tracking your time, keeping records of what you're doing and being able to substantiate what it is that you do. And I know you've told me this, Brandon, like, do I really have to track hours? I would probably rather slip my wrist and do it. But that is
Yeah,
going to
it's
be the
horrible.
insurance policy, right? And it kind of depends on how much losses we're talking about. If you're trying to offset $100,000, $200,000 worth of income, that's pretty significant. It does make sense for you to have all those documentations in place, because guess what? If you're audited and you can't substantiate that, then you're going to lose the fight and you're going to have to pay back the taxes and the penalties too. Right?
Yeah, one of my assistant's jobs, like when I hired them, I was like, if you do nothing else, like you just gotta track my hours. So I was like, just make sure I'm getting enough hours and then let me know if I'm not. But I'm like, this is important. Like that's one of their jobs is to track hours. So like even if you have to pay somebody, 40 grand a year to track your hours at a certain level, that makes sense, right? At a certain level, it's worth. Yeah.
Yeah,
Somebody said, I want to apply for your tracking hours job. You just follow me around all day and just track my hours. It'll be a great job for somebody. But that's
Oh,
funny. All
that's a
right.
lot of money to pay someone to track hours, but
It
yes,
is a lot
it
of
is
money when you can
important
just,
to do it. Yeah.
yes,
And I think
literally
it
at the end of the
also
day, you just sit
differs.
there.
Oh,
Yep.
go ahead.
Oh, this is the end of the day. Pull up a spreadsheet and just track how many hours did I put in today? Like, what was I doing? Who did I talk to? What was the action? And you can substantiate it.
Yeah, and I think it's about systems too, right? Everything we do in, I mean, real estate, your real estate investment, you want to treat it like a business. And so it's creating systems that allow you to easily track those hours or automate how you track those hours, right? That's the kind of tax planning that you can be doing with your tax advisor. But also the detailed, the level of detail for people to track their hours, I think it's going to differ from investor to investor, right? For someone, who does real estate, that's all they do. I probably wouldn't lose too much sleep if I'm not super detailed. But if you're someone who has a part-time job and you're also claiming real estate professional, you're just, it's a difference of like 800 hours versus 750. Then I would be very detailed in how I'm tracking the hours. Right? So kind
Yeah.
of
Well,
comes
it's
down
actually
to
one of the reasons. I mean, for those who are familiar, I was on the Bigger Pockets podcast for like 9 years. And one of the primary reasons that I eventually left is my wife was stepping down her hours when it came to real estate because we had kids. So she was having a hard time keeping up the real estate professional status. But if I got audited, they're like, well, you're on the podcast. They probably wouldn't count those podcast hours towards real estate. So therefore, by leaving that, now I save a whole bunch. Now it's a lot more confident. Like this is what I'm doing. Like I'm a real estate professional. This is all I do now is real estate investing. So
yep,
that's been
yep.
a big piece of it. So, all right. Well,
Yeah.
all right. So we talked real estate professional. We talked cost segregation.
Yep.
We talked depreciation, bonus depreciation, accelerated depreciation. Maybe we can just talk just a couple of seconds on if you're a limited partner. Let's say instead of the active, I think the active side, people know like, hey, I'm flipping houses full time. I'm buying a bunch of rentals. I'm fixing toilets. I'm going to be a real estate professional. Great. But for those people who are my investors, which there's many of them on here right now, what benefit do they have then? I mean, we can kind of revisit that real quick. Again, passive losses and carry forward. Anything else we want to cover on that when it comes to
Yeah. So for
accredited investors who
people,
invest with me?
yeah, for people who are purely passive, kind of like my client that I said, the retired firefighter chief,
Yes.
never
Yeah.
want to be a real estate professional, then the key is to continue to generate more passive income, right? Because now we've accumulated this bucket of usable losses. The next question becomes, then how do we generate tax efficient income? In other words, income that I don't have to pay taxes on. And for different people, it's going to be different things. Like I said, for the doctor, he wanted to invest in the surgery center. If you're an attorney, maybe, I don't know, you might invest in some kind of a startup business or something like that, right? And so different types of passive investments, and just so you know, it's not limited to real estate. Clearly, if you're a passive investor, you have single families, or you have a gain from one syndication, you can offset losses from another syndication. Or if you sold a rental, you can offset gain from another rental. But it's not just limited to that. It's all types of passive businesses or other investments that can generate income for you. Those are what I would focus on. But I think commonly too, what we see right now, a lot of people are selling real estate, right? Getting out of their properties because, this kind of reached the peak of what, they're really excited to sell. And of course, as you know, Brandon, one of the strategies we always talk about is 1031 exchange, right? Let's 1031 exchange so we can defer the capital gains down the road indefinitely. But what I'm seeing a lot with investor clients this year, and even part of last year too, is just the difficulty in finding deals themselves that make sense, right? So we have people who are like, hey, I might sell, I listed my property, it's sold already. And then you have those, 45 days, you have to try to replace the properties. And that becomes like a difficult decision of, okay, am I going to just pay the tax, or am I going to buy a property that's less than ideal or doesn't meet my investment criteria? And so that's where losses come into place, right? Maybe you don't need to do a 1031. Maybe you already have passive losses, or maybe instead of a 1031 exchange, you're going to invest passively in someone else's syndication. I actually have a friend of mine who did a 1031 exchange this year, and they didn't meet the dollar amounts for, so in other words, they sold the property, they had to buy something for, I think, 800,000, and they couldn't. The best deal they found was like 600,000. So they're going to have some taxable gain or taxable boot on that transaction. And so passive losses, syndication investments, other rental properties, those are going to be great alternative strategies, right? Because instead of paying taxes on that $200,000 deficiency, she's instead going to put that into a syndication and generate some losses to offset part of that gain that she would have to pay taxes on. So we're seeing a lot of that too. Just, make sure you're being proactive in speaking with your tax person on what's coming down the pipeline, right? So I always tell people the best time to talk to your tax person about selling or buying is not after the fact, it is before you sell. Before you sell something, even if it's a syndication, talk to your tax advisor so they can think about what are the offset strategies you can utilize.
Yeah, I agree. Just a quick point here is hopefully everybody can see, like, there's a lot of questions. We're going to do some Q&A here in a few minutes when we'll talk about this real quick, and then we'll go through kind of getting rid of real estate eventually and the recapture stuff. Then we'll do a little bit of Q&A, but just understand, like, there are so many different things out there and different ways to look at this. That's why they're all strategies, right? It's like a game of football. There's strategies that you use for certain reasons. So if you are trying to do all this on your own using like some like box software you bought at the store, and you own rental properties, please do not do that. You end up with me when I called Amanda and I'm like, hey, I've got 10 LLCs because that's what I read online you're supposed to do. And it was a mess. And it took a year to clean up the mess that I had I just gone to a good CPA who understood taxes first. So find yourself a good CPA. All right. By the way, Amanda, I saw the question a few times in here. Are you taking more clients? Are you guys full? What's your business like right now in terms of that?
Yeah, we are taking clients for tax planning. So for tax planning, yes, we are on a kind of a limited basis. So if you guys are, whoever is on the call, you can check out our website. We have a couple different ways that we can help investor clients. But yes, our focus has been heavily on tax planning for the last several years. So we kind of moved away from doing like the bookkeeping and that kind of stuff, because we feel like what a lot of people are missing is the planning piece. It's easy to find someone to file your tax return, but more difficult to find someone to help with proactive planning. But yeah, just check out our website. It's keystonecpa.com if you're interested to learn more about planning.
All right, cool. All right, so let's talk real quick again, because I'm fascinated by this topic. And I don't even know if I can spec it out on paper real well. I've never done this before, but maybe together we can figure this out. I'm going to keep this very simple. There's a million factors we're not including here, but let's just say we had a $1 million property and it turned into a $2 million property over the course of a couple of years, for simple math. I know M doesn't actually mean million. It's like MM, right? But anyway, whatever. So now we've got this $1 million gain, $1 million gain. What you can do, what people did for years, right? And we still do, is you take that $1 million, you take all the money you profited, you dump it into the next deal using a 1031 exchange. And that's what you're saying. You have 45 days to identify a property. You got to go and dump all the money into it. And then you defer your taxes to a later point. Good explanation of that, hopefully? Yep. Okay. On the other side, let's say instead, the same situation, you got the 1 million, you dump it to 2 million, or you grow it to 2 million, and you got your $1 million gain. But instead, you go and dump that into real estate. So you're 1 million, like, sorry, into a syndication. So this one, you're going to do your own syndication, sorry, your own 1031. Your $1 million, you're not going to pay any taxes on it right now because you're just doing a syndication. So let's say your $1 million bought you a $3 million property and you just wiped your taxes. How does that look here? So $1 million gain, let's say you put it into like Open Door Capital, right? Which we're all over the place. Mobile home parks usually do a lot better. Apartments anywhere from 30 to 50% of what you put in. We're typically seeing that people are getting back. Does that sound about right?
Mhm.
I think we're somewhat. So let's just say it's 40% of what you put in. Because remember, $1 million will allow us to buy roughly 300, anywhere between 250 and or 2.5 and $3 million of the real estate, right? Because we're using that as a down payment. So you put the $1 million with us, and let's just say you got a 40%, $400,000 in a loss,
Mhm.
or I guess depreciation is what we're saying, right? And I kind of stopped spelling that one correctly at one point and just let it kind of fizzle out of there at the end. All right.
We can't see.
So I guess let's talk about the benefits real quick. You get what I'm getting at here, right? Like, how do we compare the two together? This one, you're not paying taxes because you 1031, but you have to go through the hell of finding a new property that in a competitive market like now, you got to make a ton of offers, and you might buy a property that just doesn't make any money at all because most properties today don't, versus dumping into a syndication where we have a dozen people that are working, trying to find good deals all the time. But then you got to share 30% with your syndicator like myself. So how does that work? I mean, like, you're paying over here, your $1 million gain, you're going to be paying taxes on that, right? What's taxes look like on something like that?
Well, I mean, no. So in a 1031 exchange, if you have a $1 million gain, right, you're going to 1031 exchange into the replacement properties. You're not just deploying $1 million. In a 1031, you have to buy the same as the sales price. So in this example, if you
right.
sold the
So-
property for 2 million, we're going to buy $2 million worth of real estate. So if you follow all the right numbers and the right timeline, then yes, in a 1031 exchange, there's no taxes at all, because theoretically you're just deferring everything into that replacement property now, right? In a syndication, It kind of works the same way. We have $1 million gain, but I have possibly $2 million of cash, right? It doesn't mean I have $1 million cash because maybe I don't have any debt. So then the question becomes, if I was to reinvest the $2 million into different, one or several syndications, what is my K1 loss going to be, right? If it's a $2 million investment, probably highly likely that you can get a loss of $1 million on a K1, right? That's like half of that investment amount, not even considering the leverage that the fund is taking on. So the numbers can work out pretty similarly, but there's always that caveat. It depends on the deal. Depends on the deal. So maybe mobile home parks might get a little bit better depreciation than, a commercial building, right? Like a triple net commercial building, or, an apartment might be a little bit better than a specific office building. But in theory, it works the same. So that's why my friend Whitney actually coined the term lazy 1031 exchange. So that's what we're kind of describing. We're not doing a 1031 exchange, but we're just using an offset, right? We're just saying, okay, we're not directly replacing with the property, but I'm instead going to take this and buy another, syndication or rental, and creating that same loss through the same strategies: depreciation, cost segregation, bonus, and then utilizing that to offset that first gain I generated. Right? So the results could be pretty similar. To answer,
and that's the power. That's what I wanted to bring up, is a lot of people are there. I mean, for years I only knew about 1031 exchanges. That's all and I was like stressed about it. I even like sold this property, a 24 unit apartment building. I had to go buy something else. So I buy this crappy 24 unit in Ohio and tried to manage it from a long ways. And it was just a disaster. I ended up selling it after like a year and a half or something like that, for like basically what I paid for it. I basically broke even on it and had a hell of a year managing the thing. And the reason I did that is because I was on day 45 to identify this property landed on my plate. So I bought it. Had I realized I could have just invested in somebody's syndication, I would have got so much more money and had not do none of that work. I mean, I would have literally saved so much time. So I guess it's just something for people to consider, whether you invest with my company or somebody else's or your own real estate deal. The idea of, instead of a 1031, using these strategies to offset that gain can be, like you said, very similar strategies with a whole lot less stress and effort and work.
Yeah, and it's just the reality of the market, right? I mean, if we're sitting 3-4 years ago, it wasn't as difficult to find great deals. But in the
Yes.
last year or two, it's becoming more and more difficult. And so that's what we're seeing a lot from clients is kind of, like you said, that stress towards the end of, okay, I didn't do it. Or, it's perfectly fine to do a partial 1031, right? Maybe I
Yeah.
sold for 800 and I only found something good for 600,000. So I can use a 1031 exchange, and then the rest I could still use some of these offset strategies like syndications or, other real estate offset.
Yeah. Yeah, it's really good. There are some ways, it's rare, but there are ways, and we have done it, to allow 1031 money into a syndication, which, allows for some kind of unique combination of stuff there. Anyway, it's rare, but if anybody ever watching this does want to do that, like we wouldn't do it probably for less than $1 million, because it's a lot of extra steps and a lot of extra work with ticks and all that.
Yeah.
It is possible. So if anybody out there has a property that has millions and millions of dollars of equity, and you're like, wait, I'm not, your return on that equity is really small right now, you can talk to us. We might just find a deal just for you that you can sell, and then we'll buy together, and you'll make way more cash flow because you're reallocating all that, I guess, equity.
Yeah.
It's something that we don't talk a lot about, but it
Yeah.
is a neat strategy.
Yeah, definitely.
Probably
You're
should
right.
market
It's
it.
it's one that we don't ever talk about, right? But yes, that's
Yeah.
I've definitely seen that done where it's somewhat of a syndication structure, right? But involves 1031 exchange. I think you're right, because typically the sponsor group, the syndicators have to, do a lot more additional work. That's
Yep.
why these are typically accommodating to people who have a fairly significant amount of money that are going into the syndication. But yeah, we do, that definitely could work as well.
Yeah. And then I don't want to jump into it today, but somebody did make the mention about opportunity zones. That can also be an interesting one if you've got a lot of gains. But again, not really the purpose of today's class, but there are some interesting things with opportunity zones as well.
Yeah, we
So
can be,
definitely
we
look
can
into
talk for like, so before getting on, I was like, are we gonna talk for that long? What am I gonna talk about? But I feel like there's so much we haven't covered. I see
I know.
my friend Val asking him to talk about self-directed investing and, debt financing tax if you have gain in your retirement account. I mean, that topic in itself could be 4 to 8 hours. Plus opportunity zone. There's so much to go into with respect to tax planning for real estate stuff.
Do you ever do like boot camps? You ever done like a weekend, like, let's talk for 16 hours on this? I mean, people might get kind of bored after 16 hours, but I would have fun. I'd have a great time.
Yeah, I haven't,
maybe
but
we'll look into doing that sometime.
It's funny because I think Bigger Pockets asked me to do that one time last year. I didn't, I don't think we ended up doing it, but yeah, that might be something interesting to do if we can find it, enough people, if you guys want to vote for it and say, hey, this is something we want. A lot of taxes.
That's funny. Yeah, we have a group inside of I don't even know if you know about this, but inside of Open Door Capital, it's called the Cabana Club. Are you in Cabana Club? I don't even know if you know about this or if we gave you an honorary or whatever yet, but I'll give you an honorary membership. But I think you actually, anyway, so Cabana Club is for people who have invested $500,000 total across our portfolio so far, or $250,000 in any one deal. And so we take this group of the people who have given us the most amount of money, the kind of in the whatever higher dollar amount investors with us, and we do events with them. So we have one in Maui coming up here in September. We have another one in December happening in Coeur d'Alene, Idaho. So I'm not going to ask you the question now because I can call you out in front of everybody, but it might be fun to have you show up to one of these and just hang out for the Cabana Club and, just kind of be around. So we'll have to talk more about that later offline.
Yes. You need to invite me to the, I'm not familiar with
you are invited to the Cabana Club events, Amanda. And anybody else here who is in the Cabana Club, I hope you're coming out to either Maui or you're coming to Idaho this December. Flight's not included, no. So it's just like you show up, we're going to rent a boat, we're going to do some amazing outdoor dinner stuff. It's going to be awesome. So sorry, I'm not including flight for everybody. That would be fun. But it's just a way for us to get to know our kind of like our investors that have given us the most, for us to kind of connect back with them. So a Cabana Club is for our investors who have done $250,000 in one deal, $250,000 invested in one deal, or $500 across our portfolio. That is doubling in the new year. So we're going to take it from anybody who's put 500 in a deal or $1 million across our portfolio, but we'll grandfather people in. So
awesome.
Cabana Club.
Well, I might be a grandmothered in.
Yes, you will be grandmothered in.
Yes, I
all right.
love, I just love
Yeah.
talking about taxes. I'm just looking at all the chat questions pop up and, I think, I mean, it's really amazing all the different things that the government incentivizes us
Yeah.
to do. And, I know, and I want to know your why too, Brandon, but for me, because people ask me like, why do you do this? Why don't you just do real estate full time? Why do you do taxes? And it's really a passion, for both myself and my husband, Matt. We really enjoy doing this. And I think some of the work that we do is life changing. I have people who say like, wow, the amount of taxes I saved, I just never thought would be possible. Or just we have clients who just haven't paid taxes in so many years as they build their portfolio of, 10, 20, 30, 40 houses. And over the years, they just don't pay tax. And if you think about it, it's really life changing. And for a lot of our investors, with all the taxes they saved, they're really redeploying that into the communities, to help create housing for people, to help, with the tenants and all that. So I think that's the part of it that's, super rewarding. But
I love that. Yeah, I love that. I want to cover before we get out of here, because we don't have a whole lot more time. I want to cover recapture real quick. So, and then we'll do some Q&A. So what happens at some point, you got to pay the government back, right? So when we depreciate something and then we sell that asset eventually, the government's like, wait, I thought that was supposed to be, destroyed after 27 and a half years. And they're shocked that it didn't. They're like, okay, well, pay back everything that you depreciated all that time. We want that back. And with depreciation rate is what, 25% still? Is that still a thing?
Well, it's the lower of 25% or whatever your marginal rate is for the year.
Oh, okay. I didn't know that. It's the lower. That's cool. I did not know that.
Yeah. So if you happen to be someone, if your marginal rate is less than 20, less than that, then you might be paying at whatever your rate is for that particular year. But I think, a lot of people feel like.
Can you just not make money in the year? Like, that next year you're going to like, whatever, sell a bunch. You can just go quit your job, sit on the beach for the year.
Yep. That's actually a strategy that we've had clients utilize. Not to say that you'll pay zero taxes. I mean, possibly if the gain itself is small, then yes, we have clients who've paid zero capital gains tax rates. But a more practical approach is yes, timing strategically on when to exit in a year where you have lower tax rates, or timing in a year where you have other losses, right? Loss from a business or loss from other stuff, to really try to offset that. But yeah, I think there's definitely, recapture, I think oftentimes is seen as like a dirty word. Investors always like, oh my gosh, yeah, about recapture, and that's why I'm not going to do real estate. And really, it's just the concept is the time value of money, right? We're kicking the tax bill down the road so that we have more time to invest and grow our funds today. So if I asked you, Brandon, do you want to pay $30,000 in taxes today, or do you want to pay it 27 and a half years from now? Yes. I think we all have the same, just to be funny, we all have the same answer, right? No one says, please let me prepay my taxes because I want to, right? The return on investment, it's zero.
And if you, and correct me if I'm wrong here, so let's say you invest with Open Door Capital, right? So somebody gives me $250,000. Now they're in the Cabana Club. They're going to buy that, let's say we have a 3 apartment portfolio in the Sun Belt right now. So you come into the Sun Belt portfolio, you put $250K in, that grows over the next few years. And after 5 years, we sell the property. Let's just say we sell the whole portfolio. You get back your $250 that you put in. And let's just say you made another $500,000. But now you got all that depreciation. Now you got to pay all the depreciation back. But if you take that 500 that you just made and the 250 you already in, you dump it 750 more with me, you can now get depreciation on that as well, correct? In the future. And so it kind of offsets that gain. So you're kind of on this treadmill, but that's not a bad thing. Is that correct?
Yeah, exactly. Again, that's the goal is we want to defer paying taxes, right? As much as possible. And maybe through some of that, we can have some tax-free money with proper planning too. But yeah, it's always, the later, the less I have to pay tax, the better. And actually, so inflation does help from that perspective, right? If I owed $100,000 in taxes, but I'm not going to pay it for a lot of years to come, then great, because maybe the $100,000 is only worth like 20 by the time we actually get there. So next year. Or next year, hopefully not. But
hopefully inflation's not that bad.
Yeah,
Oh, that's
but I
funny.
think it's so powerful. You know, I know we joke and talk about like, oh yeah, all the wealthy people. You know, it's funny because like I think it's Warren Buffett who said he pays less tax or lower tax rate than his secretary, right? And you
Yep.
and I joke that you pay less tax than some of your
Yep.
interns.
Yep.
Um, and it's, you know, it's shocking, but it's true. And these are the kinds of strategies. I mean, it's really available to everybody, but the tax law is not just for one person. Like, okay, you can't use it, but you just have to do the right planning and do the right thing. So we might have people on here with us today who, you know, are thinking about real estate but not buying it or just fearful for all different kinds of reasons. Then yes, in that scenario, it's probably not going to apply to you, right? Not right now, at least. But when you start to buy real estate, you'll get some of the benefits. You might not be someone who can pay zero taxes like Brandon because you and your spouse are both working full time. But that doesn't always have to be your facts. You can change your facts so that at some point, whether it's 2 years from now, 3 years from now, 5 years from now, you can have more control over your tax bill and how much money you actually get to keep, right? Not just make, but how much do you actually get to keep?
Yeah, yeah, that's great. So yeah, it's a fun game, real estate investing, and the rules are set by the IRS, right? And so we're whether or not they're right or wrong. I mean, I'm sure a lot of stuff is probably not good, but we're just playing within the rules that are set, and we're saying, hey, this is what the IRS says. We're going to do the things that they encourage us to do, and we're going to pay a lot less taxes, hopefully. And because of that, I actually did an analysis one time, and then Amanda, I think you looked it over for me, but I ran the numbers on if you were to just pay the taxes every time on like a 1031 exchange or on a syndication or whatever, versus if you were to reinvest that money and grow it over time. And because of the time value of money, like because you're basically using the government's money that you owe them to reinvest in deals that will grow bigger because of that. Anyway, the way that compounds over time, it's still significantly better. Even if someday you decide to just pay all the tax and just be done with it, it's still better than if you were to pay the tax along the way. So just another benefit for people, even if you do pay it all back. But my hope, I said earlier, we're going to talk about death and taxes. My hope is to someday just die and then not worry about it. You know, so like eventually I'll dump my money into a forever fund, which actually we're going to probably launch either later this year or early next year. We're going to actually literally call it, you guys are hearing it kind of first here, the Forever Fund. And it's going to be a collection of properties that we'll probably do like one a year. That's like, we do not sell this ever. We hold on forever. There's no plan to sell it. The debt we're going to hold forever. This is a cash flow forever fund with the idea that people can kind of like, oh, okay, I just want to be done. I just want to dump it in. I don't care about maximizing my return to the greatest moment to sell at the exact peak. They just want to hold it for good. So anyway, that's coming.
Yeah, that's exciting.
Yeah. Yeah. We'll talk more about the Forever Fund, Amanda, soon. We got to game plan that one a little bit, but all right. So we're going to get everyone out of here in just a couple minutes. Let's do some Q&A. Before we do, I will say this. I mentioned it earlier. What I do for a business, I do syndication. So we raise money. We've worked with over 1,000 accredited investors at this point. You do have to be accredited to work with me as of now. Maybe someday I'll do a Reg A, which you don't have to. But right now, you got to be an accredited investor. We are raising for a 3-apartment portfolio in the Southwest. We're 30 million raised out of 34. So we're at, what's that, 85%, 90% full. We have commitments all the way up to 100%, but not all the money's been wired in. So I would love to have you join me. I'm invested in that deal as well, as are a lot of other people. So we'd love to have you in that. And if you want more on that, just shoot me a DM on Instagram or email us. My company at investors at odcfund.com. Would somebody throw that in the chat area for everyone to see? Just investors at odcfund.com. And Amanda, where can people reach out to you? And then we'll do some Q&A.
Yeah. Well, I mean, before I talk about my website and all that, I think something so interesting about passive invest. So, you know, for me, myself, right, I have my portfolio of single family and small multifamily, but I'm also a syndication investor too. And you know, syndication investment for me, it's the ability to scale, right? So like I said earlier, I'm passionate about what I do, which is helping people save taxes. I myself don't want to become Brandon Turner at all, but I do want to utilize like him and
rough.
his team and the systems and all that stuff, right? Yeah, not a dig. And to utilize that to grow my wealth in a way that still allows me to go to my kids' baseball games, right? That I don't have to be there to manage my real estate and apartment and all that kind of stuff. So yeah, I mean, I definitely consider that as an option, regardless of which, investment or syndicator you're going to be working with. And timing is a big difference too. We were talking earlier about how the government incentivizes to do certain things with bonus depreciation. That 2022 is the last year of 100% bonus depreciation. And that's huge. And I see that firsthand of that incentivizing investors to buy more real estate, to rehab their properties, to make them better for their tenants, right? And so it's really important to take advantage of the rules, the tax law, play within the rules, but to take advantage of them while they exist, because there's no guarantee that they will be here next year or after some election, or even by the end of the year. Who knows? That could change at any time. But yes, I saw a lot of people asking about if I'm doing a boot camp because Brandon talked about it. So yeah, I would love to do one. But in the meantime, we do have a different tax planning services for real estate investors, from the newbie investor to experienced, very experienced real estate investors like Brandon. So you can check out those out on our website. It's keystonecpa.com, KEYSTONE CPA.com. And if for any of you guys who I know we went super fast on all this stuff, if you want to know more about depreciation or entity structuring, which we didn't even talk about, real estate professional status, retirement investing, we have 2 free ebooks on our website that you can check out as well. Just go to keystonecpa.com and you can't miss it.
There you go. All right. Well, let's do some Q&A. Any questions? Now, again, disclaimer, obviously, I don't know, you probably have your own disclaimer, but I'm an entertainer and a real estate investor, so I'm not giving you legal or tax advice here. But we're going to do our best to at least try to give our opinions on some stuff. Amanda, anything you want to say on that?
Yeah, I'm just going to say, if I'm not your CPA, then this is educational only. Everything. So all the strategies that we share, whether it's today or anytime you hear me talk about anything, are all true strategies that we use with our clients. But whether or not it applies to you today or tomorrow or anytime, I don't know that, because I don't know your profile. So make sure you check everything out with your current tax advisor to see if that is beneficial for you. So don't run out and get a cost segregation. Don't run out and do something expecting a huge payoff. Make sure you're talking to your tax person. So I think that's my only caveat, but I didn't know that you were an entertainer, Brandon, but I guess you are an entertainer.
I'm an entertainer. I'm like a monkey in a with the little cymbals banging around. It's great. All right, questions. Let's see. Yeah, the accredited investor, I think some people have answered that in the chat, but we'll say it again anyway. Accredited investor there's a few definitions or a few ways you get there, right? But you filing a loan, you make $200,000 a year, married $300,000 a year, or $1 million net worth, not counting your primary residence equity. Is that all correct, Amanda?
Yep.
Plus some tests you can take, but nobody does that.
Yeah, or you could be a sophisticated investor, which is kind of like you're like a CPA or a financial planner, where you're kind of in the trades of investing.
Yeah. Can I invest via self-directed Roth IRAs? So for us, yes, we do work with self-directed Roth IRAs. However, a lot of the tax stuff is going to be totally different because, right, I don't know if you want to talk to that at all, Amanda, but
yeah,
you probably don't even need all the benefits.
I'll talk about retirement investing a little bit because I know that came up a little bit in the chat and people were asking to hear about it. So retirement investing in real estate in general, okay, whether syndication or just a single family home, is treated very differently than using your cash and leverage. On the plus side, retirement money is tax preferred. So that means it's either tax-free or tax deferred, right? So there's a preference there. We don't have to worry about 1031 exchange or any of that stuff because you're not going to pay taxes until you pull money out, right? Typically speaking. But one of the hurdles that we worry about when it comes to retirement investing in real estate is with respect to debt. So what happens is the IRS says, hey, you can use your retirement money, let's say IRA or Roth IRA, you can invest in a syndication or a single family home, right? And that's all fine. It's going to grow tax deferred, tax free. But if there's leverage on it, meaning I put 50,000 from my IRA and I'm investing in $100,000 property, there's debt involved, then that means that the leverage portion is not going to get the benefits because that's not really retirement money. That's money outside of retirement. So a lot of times investors are shocked by the fact that if there's an exit, right, or if there's taxable cash flow or a capital gain, that the retirement money might have to pay taxes on that gain. But if you think about it, it kind of makes sense, right? Because my retirement money is still growing tax deferred, but the fact that there was leverage, non-retirement money, that would still be taxed because it's not part of what was protected under the retirement itself. So for people who have utilized retirement money to invest in real estate properties or syndications, it's really important before the exit, right? Before you sell property, before the syndication exits, that you let your tax advisor know, hey, here's what's going to happen. Here's what I'm expecting, right? So then they can look at what are some strategies? Are there other ways to help you minimize the taxes or offset strategies? But again, those things have to happen before the sale, right? After the property is sold, like with anything, it's kind of done. There's not too much you can do in terms of after the fact planning. But I just want to say there are a lot of CPAs who advise people against using retirement money for real estate and syndications. And we're not that from that school of thought. The way I look at it is if you can generate great returns with retirement accounts, like if you can do that better than what it's doing in the stock market, it still makes sense, even if you have to pay some taxes, right? Because with debt financing tax on capital gains specifically, that's at capital gains rates. So again, it's something that you would have otherwise probably paid anyway if you invested personally. So it's really not the end of the world. I generally don't make an investment decision based on taxes, right? Because your tax is never going to be at 100%. So if I'm still making more money after taxes, that still could make sense.
All right. Next question. Let's see. Goes back to the real estate professional one. Let's see. I live in Orange County. I'm working full time. Can my wife part time become a real estate professional status in California? So I think that's yes, right? As long as that's not their full, as long as they meet those qualifications.
Yeah, definitely. So that's a perfect example, right? If your spouse is working part-time, the question becomes, can she spend or he, at least 750 hours in real estate and more time than their part-time job. So if her part-time job is 800 hours, she needs to have more than 800 hours. That's pretty much it.
Does a K1 necessarily mean passive income they can offset if, or is that not necessarily? Somebody just said, can real estate losses offset K1 income?
Yeah, that's a great question. It depends. So K1 by itself does not necessarily mean active or passive, right? So for example, Brandon gets a K1, but it's not passive. But if, John Smith got a K1, it might be passive. But yeah, if you're getting a K1, that's a great starting point to say, are you passive with respect to that K1? And if not, are there things you can do to become passive in that K1? If what you're trying to do is to utilize some passive losses, right? So we have clients who did that as well. It's like, hey, I could be passive or not with respect to this income, and I want to be passive, so I can use my real estate losses. And so it just takes a little bit more planning on how to get to that passive designation.
All right. Let's see. I know Open Door Capital has been touting possibly opening up 1031 friendly funds. What's the timeline on that? That just goes down to if somebody could do $1 million or more, we would probably put the work into doing one. It wouldn't be like right now into a deal we have right now, but we'd work it for a future deal. So we'd work with you. If you have over $1 million, we can make that happen. That you're going to be dumping in. And then what's the timeline for the Forever Fund? I don't have one other than that I'd like to get one done by the end of the year, but it could be early next year. But I would love to do that launch of Forever Fund in like December. Let's see. Next question here.
Oh, can I add something real quick? So for those of you guys who are looking to invest, whether it's a syndication or your own single family home, we were talking earlier about the urgency, right, of this year, 2022, 100% bonus depreciation. I just want to clarify, it's not as simple as just buying a property. you have to actually put the property in service. So if you're doing like a BRRRR strategy, if you're just still rehabbing it before the end of the year, you don't get to take depreciation because it's not in service, meaning
That's good.
advertised and available for rent. Same thing for syndication. If you're investing in a syndication, it's more than just putting the money in the fund. The fund actually has to own real estate, right? So the fund itself is going to have purchased an apartment or a mobile home park, and they have to actually be rented out. So just something seemingly small, but very important to know because it makes a world of a difference. If you're trying to offset some gain and you have a K1 that shows like 0 losses, you might be shocked.
There you go. Alan asks, can condos be depreciated?
Yeah, certainly. Condos are great, a lot of times because a lot of times the condo owner doesn't own the land. So earlier, Brandon was talking about how, we can only depreciate the building and not the land. So that's an example where a condo sometimes is pretty good because land value is probably very low.
All right, let's see. Oops, I lost the chat. Hold on. Somebody asked for the link again to that document. Does anybody want to have a link to that document they can throw up, that Google Drive link I threw in there? Roxanne talking with Ryan Murdoch today about the Open Door Fund. Hey, by the way, so I got a whole team of people who are talking with potential investors with ODC. So if you guys have any interest in that, please let us know. You can hit us up on the website, odcfund.com. You can hit me up on Instagram directly. You can, come hang out with me in Hawaii the next few days, whatever. Just let me know how we can work together. Let's see. Wes said, how much is a 30-minute Zoom business advice session with Brandon? LOL, but for real. I don't do it, man. I got no time. If you get in the Cabana Club, I will do a 30-minute Zoom business meeting with anybody in the Cabana Club. But no, the way that I currently do it, just because I don't have time, I don't see my kids enough as it is. I want to see them way more. And I'm doing okay, but I want to see them more. But I do things like the Maui Mastermind, which is a mastermind I hold in Maui for real estate investors who are active. So we do things like that. MauiMasterClass.com if you're interested in that. And then I go to conferences. I'll be at BPCon this year. Are you going to be at BPCon, Amanda?
Yeah, I am. But I will share this. So last year when I was at BPCon, I caught Brandon just sitting by himself in the lobby. And he was, I don't know who you're talking to, Brandon, but I think you were just talking to some attendee for like an hour. So if you catch him at the right time, it's free to chat with Brandon forever.
There you go. Yeah, that's funny. Yeah, actually, like, when I go to conferences, a lot of people that are like speakers will go to a conference, they'll fly in, they'll do their speech and they'll leave. Like, I just kind of make it a point whenever I go to a conference, I just stay the entire time and just hang out in the lobby. Cause I'm like, it's like the only time I get to actually connect one-on-one with people. So yeah, works pretty well. Let's see. Somebody said, I missed the entire presentation. Will they be recording? Yes, I'll send that out. It should go automatically. If not, I'll figure out how to make it go out tomorrow when my team goes up. All right. I had a lot of questions in here, Amanda, about short-term rentals. How does this stuff we're talking about today apply to short-term rentals?
So somewhat for short-term rental investors, we also get bonus depreciation, cost segregation, right? All those strategies, write-offs, all those are exactly the same. But for short-term rentals, has nothing to do with real estate professional status. So it actually works really well for people who are both working full-time. But yeah, to find out more about short-term rentals, I just released a ebook on my website. So you can go to KeystoneCPA.com. We did one specifically on short-term rentals because there's just a lot of people who are investing in short-term rentals. And there's a lot of tax things to talk about. So it's another one of those topics, Brandon, that we probably want to do like a whole hour and a half just on that.
That's funny. Do you ever think about, you don't have a podcast right now, do you?
I don't. Just whenever I talk to you and you make me record it like this.
I feel like you'd be a great podcast, like the tax lady with Amanda Hahn. I don't know.
Let's do it. Yeah, so far I like all your ideas, Brandon. A tax boot camp. You signed me up for a tax boot camp, a podcast.
Yeah, you could have the biggest tax podcast in the world. There's probably like 4, but you'd have a legit one. All right.
Max
one more thing I wanted to say. You brought this up earlier, Amanda, but I wanted to just throw this out there. The difference, like what you do, right? Like you're not sitting out there looking for deals, building a team, trying to do all the active work when it comes to real estate. Instead, you make money where you make money best, which is your career. And a lot of people in real estate, like a lot of people, I'm going to bring out this chart for this thing. So I talk to people all the time who are very successful in certain areas of their life. Like they are salespeople that work for a company and they're bringing in $1 million a year or whatever. Like they've been in a business for 15 years in a furniture store and they're making a $500,000 a year or whatever. So what's interesting is like, if you look at the timeline of success, like if this was like years, right? Each of these are years. It takes a long time. And this is like success. We'll call it monetary success. It takes a long time sometimes to become successful at something, right? This is like exponential growth of how almost everything is. Like I'm guessing, Amanda, if you look at Keystone CPA, it probably looks something like this. If I look at my business, it looked like this. If you look at a furniture store, it probably looks like this for most people. So here's what I find happens all the time. People get right about here with their business and they get bored. And they start listening to the Bigger Pockets podcast or some other podcast. And they get excited about real estate. And all of a sudden they go back from here and they start all over brand new right here with buying their own rental properties. Now, I'm not saying you should not do your own deals. You can do your own deals. Nothing wrong with it. I'm not discouraging it at all. But a lot of people would be way better off asking, how do I get from $1 million a year to $2 million a year? Then how do I change the toilet in a duplex? And that's why I do what I do, because I was in that boat where with Bigger Pockets, all that, I was like here. And I was like, how do I invest this money? And instead of going back to doing it all myself, I just dumped into syndications. And I did a bunch of other people's syndications first. And then I thought, well, I don't really like the way that everyone else does their syndications. I think that there's a lot of problems. So I started my own just so I could dump my own cash in it. So now when you think of like a good syndicator, again, it could be me, it could be somebody else, but we're like right here. Our syndication company has years of experience and heartache and hassle and whatever. So now you can be here with your career and you can invest here with your money. So you keep doing better and better in your career or your whatever way you make money, keep doing that, make a bunch of money, dump it into an experienced syndicator who's here, not here, and watch your money grow way more rapidly. That's why I'm almost more passionate these days about teaching business entrepreneurs how to 10x their growth than I am real estate investors how to buy a duplex. Because like I've been there. So just something to consider. You don't have to buy a duplex and start changing toilets to be able to grow wealth in real estate. There's other avenues. So that's my final word of the day. Amanda, anything you want to close up with before we get out of here? I know we got a million questions we didn't get to, but
I know
we'll have to do some Instagram lives together or something.
Yes. So I think that, I mean, you're exactly right in terms of, for us, we work with investors who are full-time real estate, that's all they do. They love it. We also work with clients who love real estate as a passive, right? All they want to do is passive investments, whether it's syndications or out-of-state turnkey. Like I said, there's absolutely tax advantages to doing that. And for me, I'm kind of like that mixture, I love real estate, but I don't want that to be my job or to scale. Yeah. And this book, for any of you who haven't read it, Brandon, you told me actually about this book, Who Not How, when one of our tax planning meetings, is I should read this. And I think this is how I applied this concept to real estate investing. Like for me, I wanted to scale. I wanted to be involved in larger and bigger deals, but I didn't want to do it. So I asked myself the question, who, right? Who can do it for me instead of me learning how? Amanda's busy doing taxes and planning. There's so much in tax changes all the time. So I need the who's to help me with the investment side in terms of scaling. I mean, I can buy a lot more single family and small duplexes, but it's in finding the who and the team to help you do that.
Awesome. Well, I love it, Amanda. Thank you so much. It was an hour. That hour and a half flew by.
Right? Like we were so nervous. Like, are we gonna?
I know. We're like, we'll probably get like 40 minutes and run out of stuff to talk about. Oh, funny. I love when that happens.
Yeah.
All right. Thank you, everybody. And hey, if you're thinking now, you watch this and you're like, hey, maybe I'll invest in one of Brandon's deals, shoot me a DM over on Instagram, just Beardy Brandon. And if I can, I'll actually get on the phone with you and we can chat about it. So just Beardy Brandon on Instagram and connect with Amanda as well. And thank you, everybody. You guys are awesome. Thank you. Have a fantastic evening and we'll see you next time. Bye.